There are many arguments both for and against whole life insurance, but here's the big question we get. What exactly is participating whole life insurance, and can it help me financially? By the end of this video, you'll know what participating whole life insurance is and how to determine if it is right for you. Participating whole life insurance is a type of permanent life insurance that provides a death benefit, cash value growth, and an opportunity to earn dividends. The participating part of participating whole life insurance refers to the opportunity to earn dividends, but we'll talk more about this in just a moment. A participating whole life insurance contract is designed to remain in force for the insured's whole life, hence the name whole life insurance, and it typically requires a premium to be paid every year. The life insurance contract is between the policy owner and the insurance company, where the insurance company contractually guarantees to pay the beneficiaries of the policy a death benefit upon the death of the insured. There are two main types of whole life insurance: participating whole life insurance and non-participating whole life insurance. These words, participating and non-participating, are keywords in helping us know how the policy may perform. As mentioned earlier, participating means the policy is eligible to receive dividends. So a participating policy will share in the profits of the company, earning dividends in accordance with the terms and conditions of the policy. A non-participating policy does not participate in sharing the profits of the company, and it is not eligible to receive dividends. Most of the time, participating policies are written with mutual life insurance companies, and non-participating policies are written with stock-held companies, but this isn't always the case. In order to determine if something was worth its salt or worth the time, effort, or investment, my grandpa had some great advice. The first step was to make a list of all the pros and cons, so let's do that now for participating whole life insurance. For the pros, participating whole life insurance builds equity, it has guaranteed growth, accessible cash value, dividends, guaranteed death benefit, and it grows tax deferred. On the con side, participating whole life insurance does have initial premium costs, withdrawals reduce growth, and improperly managed policy loans, which are a big thing that we'll talk about. Grandpa's next step was to look in detail at each item listed. One of the major pros of whole life insurance is the ability it has to build equity. The equity in whole life insurance is called cash value, and it is guaranteed by the policy contract to grow throughout the life of the policy. When the policy is designed well, the cash value can grow so significantly that it will eventually surpass the total amount of premiums paid into a policy. When a policy's cash value is greater than the total amount of premium ever paid into the contract, that's very exciting. Because of the growth in the policy, you now have access to more money than what you've spent in premiums, and you also have a death benefit for your loved ones. Some people make the comparison that when the policy gets to this point, it's like having free insurance. But as a life insurance agent, I can't go around saying, oh, look, your insurance is free. But I can tell you that when a policy has more cash value than the total premiums ever paid, that's a good spot to be. The cash value of a life insurance policy is contractually guaranteed by the insurance company, and it is available for the policy owner to borrow at any time. There are no penalties or fees to access the policy's cash value, nor is there a list of qualified expenses for which the money must be used. Policyholders can borrow cash value for any reason, and that's a big pro. The policy owner can also access the policy's cash value by surrendering part or all of the policy's death benefit and withdrawing the cash value equity from the policy. A pro that's easy to look over, perhaps because it is so obvious, is that whole life insurance policies have a guaranteed death benefit. This death benefit is determined and set when the policy is first purchased. The insurance company guarantees a base death benefit amount when they know they can provide for the whole life of the contract, and then premiums are determined based on age and health to support the guaranteed death benefit. In well-designed whole life policies, the death benefit has the ability to grow. When a death benefit grows, the growth becomes the new guarantee. An example of this would be a policy that starts with a base death benefit of, let's say, $500,000. This $500,000 amount is the death benefit the insurance company knows they can provide for your whole life based on the amount of premium you're paying. Next year, the policy grows and the new death benefit might be $520,000. So this $520,000 amount now becomes the new guarantee, the amount the insurance company promises to provide for your whole life. Another pro, a bonus pro, with participating whole life insurance is that the insurance company shares excess profits with their policyholders. This is called a dividend. In most cases, dividends are not treated as taxable income because the insurance company classifies them as a return of premium. This is really nice for us policyholders because, well, first, it's no fun to pay more taxes, but also because dividends can really boost the performance of a policy. There are a few options to choose when it comes to dividend allocation. We can have the dividends accumulated interest, we can have the dividends paid in cash, we can have dividends reduce the amount of premium we pay each year, and we can have the dividends reduce any outstanding loan balance, or our favorite option, we can have the dividend purchase paid-up insurance. The reason we like the dividend to purchase paid-up insurance is because it increases our policy's available cash value and it increases the policy's death benefit. It's a great way to add on to our policies without increasing the premium. Now, let's talk about the cons. The biggest con of whole life insurance policies is not actually a problem with the policy. Rather, it's a problem with how the policy is managed. Poor management can turn a life insurance policy into a tax liability, a really big tax liability. For example, a policy loan, as with any other loan, will be subject to interest from the insurance company on an annual basis for as long as the policy loan is outstanding. If the loan interest is not paid, it will start accumulating alongside the outstanding loan balance. If the loan interest goes unpaid, the insurance company will charge interest on unpaid interest. Albert Einstein said the eighth wonder of the world was compounding interest. And that is true. Compounding interest is a beautiful thing when it compounds in your favor. But when it compounds against you, it's not so pretty. Like when loan interest is not paid, interest starts compounding on the unpaid interest and it can quickly get out of hand, causing the policy to lapse due to overloan. And if this happens, there could be really serious tax implications. That being said, the easiest way to avoid this situation is simply to pay the loan interest. As long as the premium and the loan interest is paid, the policy won't lapse due to overloan, and the owner of the policy can continue to use the policy's cash value whenever and however they choose. If you're wanting to avoid loan interest altogether, you can also access the policy's cash value via a withdrawal. But this comes with a downside. Withdrawals permanently decrease the size of the policy. Unlike a policy loan, which can be paid back, money that is withdrawn can never be put back into the policy. Surrendering portions of the policy will also reduce the amount of growth the policy would have created. Another con could be the initial premium costs of a whole life insurance policy. Whole life insurance is a slow and steady type of product. It takes time to develop and grow, and there are some ways it can be structured to help boost cash values in the early years and help ease some of the starting costs. Although you can access the policy's cash values in as little as 30 days, it will take a few years before a whole life policy starts generating more cash value than total premiums paid. So now that we've covered the pros and cons and details, it's time to apply my grandpa's last step, comparison. Grandpa said to compare the list of pros and list of cons and see which one was longer and then determine if the upsides outweighed the downsides. So once again, following his advice, we can see that in a nutshell, participating in whole life insurance is good for creating a legacy with a death benefit to provide for your loved ones when you're gone, building sustainable wealth with tax-deferred growth that is accessible to you at any time for any reason, and also providing you the opportunity to share the insurance company's profits in the form of a dividend. But if you're not responsible, participating in whole life insurance could create a bad tax situation for you and a financial loss. It's all about how you manage it. So now you know what participating in whole life insurance is and a little about how it can be used. We've covered the upsides and the downsides. Now it's up to you to determine if the pros outweigh the cons. If your interest was piqued and you'd like to see what a participating whole life policy could look like working in your specific financial situation, it would be our pleasure to assist you. Please contact our office so we can discuss your specific financial situation and design a life insurance policy that will work the best for you. For those of you who already have a life insurance policy but aren't sure if it's a participating whole life insurance policy or if it was designed to work the best for you, we can help you too. Send us a copy of your policy and we'll look at it with you. If you have a good policy, we'll tell you. If you don't have a good policy, we'll tell you that also and help you know what options you may have.